Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, July the 25th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we're talking about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data across the pond, but here in the United States, we did get Richmond Manufacturing Index, came in at 14 versus the expected 7, so much better than expected there. Nice to see, as opposed to what we were seeing yesterday in many of the economic data points. And then we got the CB consumer confidence came in at 121.1, was expected to be 116.5, and they revised last month's number down slightly to 117.3 versus the 118.9. That's about it for the economic data for the most part. Like I said, we do have quite a few numbers coming out, especially tomorrow. We have existing home sales, crude oil inventory, and the Fed Fund FOMC meeting, so new home sales as well. I don't know if I mentioned new home sales. I think I did, probably twice. Anyway, so a lot of data, good data coming out tomorrow. Also, just all kinds of earnings. We've got Amazon, AT&T, Chipotle. I'm probably not even going to touch Chipotle after the news that's been out there lately. Express Scripts, Texas Instruments, and U.S. Steel I'm going to be looking at tonight after the close. We also got Hess, Ford, General Dynamics, and Coca-Cola coming out tomorrow morning. So I'm going to be looking at all of those. As a matter of fact, I'll talk about a funny thing that happened to me this morning and kind of lost it for a second, but I'll talk about that in a minute. Anyway, crude oil moving much higher today. Not anything to do with the economic data tomorrow coming out. I believe it has to do with Saudi Arabia coming out and saying that they're going to limit production and they're going to limit shipments to the United States. But the fact of the matter is there's like oil tankers out there. I think there's like 20% of oil tankers out there don't have a destination right now. Basically, they're floating storage tanks because there's such a glut of oil around the world that they just really don't have a place to go. They're going to try and talk to Iran, Libya, and a couple of the other countries to limit production. Some of those countries have said that they aren't going to limit production. They don't even have a cap right now, but Saudi Arabia is going to try and talk them into limit production at their current levels. But Iran, Iraq, like I said, Libya, and a few other ones just probably aren't going to do that at this point. But that's what's making crude oil move higher today, I believe. And then on to gold futures, looking like it's kind of topped out. It is finding support on the 50 fib level, which just happens to coincide with the point of control where the most time and volume has been spent. That is a magnet and support on the 50. So I could, it's kind of stuck there. It really needs to kind of break through that to get any movement to the upside or the downside at this point. But gold futures coming off as the equities were really rallying. Looks like the bonds have subsided down a 1.5 today. That whole fear of the debt ceiling just was baloney as far as I'm concerned. Plus we're heading into this FOMC. I think some people are coming to the realization, probably are getting a little overzealous and a little over our ski tips in a sense on trying to push this higher ahead of a FOMC meeting. Then the the NASDAQ making a new historical high yesterday. Today it's down just slightly, albeit the bar is positive. The fact of the matter is it is in negative territory because it opened much lower. But NASDAQ down just slightly on the day, probably being pulled down somewhat by Tesla. The E-mini S&Ps, on the other hand, making new historical highs today, just blasting off with not a whole lot of volume, but it does seem like there's a lot of things going on. I think most of it's jockeying back and forth with this this is like one of the busiest earnings weeks of the year. So a lot of people playing around in there. But E-mini S&P is on the 30-minute chart. You can see just kind of almost looking like it actually did. It kind of gapped out to the upside today in the E-mini S&Ps. Anyway, on to a few trades that I've done. General Dynamics, I actually did this yesterday because they've got earnings coming out. I didn't want to mess with it. Plus, it came up and tested this channel that I had. Remember, broke down below it, and now it's acting as resistance on the way up. So I decided to cover that trade. So if you remember with General Dynamics, I had on the November 115 synthetic long position in there. That was based on Steve Primo's call to action on that one, and basically I did a little bit better than what his rule, where his rule was 200% to the upside. I got about 300% on this one to the upside, and I originally paid $2.10, sold it out for $5.57. It's probably still a winner today, but it's starting to look a little iffy on that one. Probably people starting to cover and get out ahead of that earnings going forward there. Also, I did cover CVX today, but Costco was another one that I covered in my IRA, and I covered it in my margin account. So in the IRA, if you remember, Costco, I had that really defined risk just to limit some of your margin on that, because they don't give you very much of a margin cut in there. So in Costco, I originally sold the 145 puts and then bought the 125 puts to define that risk, just to make it so that they didn't kill me on the margins in there. But having said that, the 125 puts wasn't really to limit my risk at all. I would have been out way before that. If you follow these market commentaries and things of that nature, you know that when I am defining the risk in a IRA, it isn't to limit my risk necessarily. It's just to appease the powers that be that write the rules for margin account or for IRA accounts. Anyway, I sold that originally for 92 cents, bought it back for 49 cents. Not quite the 50%, the width of my 50%, the max profit potential in that, which would have been, right around 46 cents or something. But I was able to get out of that one for very close to that, because in the margin account, I ended up selling the 145 puts outright naked. And with that one, I originally collected just over $1 in there and bought them back for 46 cents. It was right around 96 cents, I think, and bought it back for 46 cents today in Costco. So out of both of those in my margin and in my trading account. This is CVX. This was the one that I was talking about. Did not cover this yesterday when I was looking at General Dynamics. I was looking to cover it, just I guess I wanted the penny and not the trade. So I ended up pulling the ripcord on that one today. And in CVX, what I had on was the September 105 calls that I was short, and then long the 105 puts because it was a synthetic short. It was a winner yesterday based on Primo's call to action there, and today blasting above that 50-day moving average, pulled the ripcord on it. CVX, I originally paid $1.95 for it and got out for 84 cents in that one. So that was a bit of a loss, but I guess I made it up in the General Dynamics. But should have covered that yesterday. Kind of kicking myself. I was meaning to, and just got away from me because I was going on to the earnings trades and just left it in there and kind of forgot about it towards the end of the day. But with Google, took advantage of the high implied volatility in there. It went into the July weeklies that expire on Friday, and I sold the 920 puts in there, and I originally collected $2.60 for that and bought them back for 60 cents this morning. So despite the fact that I got the directional move incorrect, I was able, because of the high implied volatility, you can see the crush happening, directionally wrong, but still right, because I sold those rather than try to buy something like that. Market maker move on that was around $33. It stayed inside that market maker move, which is just what we're looking for on an earnings trade. So that's the beauty in selling options premium. The probabilities were in my favor, and got that vol crush, was able to take advantage of it being directionally wrong. So that's why I love the options. I thought it was going to come out with better earnings and better forward guidance and things of that nature and spike up, but you know, you can see that being directionally wrong is okay a lot of times when you're selling premium, which is what I say is like you're playing the probabilities. So it's less risky than what the regulators believe it to be. And with McDonald's, I thought they would come out with better earnings as well. And at McDonald's, I did the July, sold the 146 puts in there as well. And in McDonald's, I originally sold those for, I think it was about $2.60, I believe. I'll have to double check that. I can't remember right offhand for some reason. With McDonald's, I ended up selling those. Oh, sorry. No, I sold those for 61 cents and bought them back for 3 cents. Sorry about that. So McDonald's, nice little profit there. Directionally right, vol crush, all things good. You know, I mean, that's what we play for. And then ULTA, this is a trade that I was talking about that was kind of funny, because today I was looking at ULTA, has high implied volatility, no earnings in this upcoming cycle, and I decided to go kind of big on it. It looks like it's kind of bottomed out there, and I was able to get quite a ways down because of that high implied volatility. And I went in there and sold the August 235 puts for $1.35, and then started getting ready for this. I did that like early this morning, and market rallied for me. But then I started looking at all these earnings trades that I could be doing, but ate up a lot of margin with ULTA, so I wanted to free up a lot of that margin back, and bought them back for $1.15. So got out of that one rather quickly, and it was nice that it was a profit, but it did kind of pop there. Want that margin for all of these other trades. I'd rather play Amgen, Texas Instruments, U.S. Steel, Hess, probably General Dynamics and Coca-Cola, at least some of those. Try and fill up my margin with that. So that's the thing with the earnings season. You got to have a lot of margin in your account to be able to take advantage of that volatility, because I like to do some of the naked strategies in there. So that's about all I got for you guys. Friday's webinar is going to be on the straddle with no downside risk. So we'll be able to eliminate the downside, maybe still collect a credit, even if it goes against us to the downside and goes through our defined risk aspect of that. Now, I'm going to go into all the rules and details as to how to increase your probabilities in that type of scenario in that webinar. So go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.